Many fund houses are rushing to launch passive debt funds like index funds, ETFs, which come with target maturity. Now, according to fund houses, the 5 year space has seen yields rise by over 50 basis points since its lows in December 2020. Such funds are being positioned for investors looking to invest with a 4 year plus investment horizon. And the beauty of these funds is that they are simple roll down products with no active management, thus making it very easy to track if they stay invested till maturity. Fund houses are also positioning these funds as part of an investor's core portfolio. So today we are going to discuss how to fix your fixed income with new debt investment avenues. And joining in, we have Mahindra Jaju, CIO of Fixed Income at Mirae Asset Investment Managers, and Harish Menon, co-founder of the House of Alpha Wealth Management. Gentlemen, thank you very much for joining in at a time when people are wondering where is the income in fixed income. It's good to know that it can be fixed at least at some level. So, Mr. Jaju, let me begin with you. First, there is not a lot of awareness yet on the passive side of debt funds. So let's begin by first understanding what exactly are debt ETFs or debt index funds, and what has been the growth in this segment.
Yeah, so basically the debt ETFs or the debt index funds are basically following a passive strategy. In the debt index fund, like in all other index funds, the strategy follows a particular index, and the objective is to replicate the returns of the index. In this case, the investor knows exactly what would be the composition of the portfolio and what kind of returns to expect. There are two primary types of index funds and the ETFs which have been popular in India. One is called a constant maturity fund, and the other one is a target maturity fund. So, in case of a constant maturity fund, the duration of the index is kept constant. So, say for example, if the fund is investing in 10-year maturity bonds, then after 1 year, those bonds will become 9-year bonds and they will be replaced by new bonds which will have a maturity of 10 years. So, with a periodic rebalancing, a constant maturity fund will typically have a constant maturity in the given band. In the example that I gave you, it is about 10 years. Then there is another feature which is target maturity fund, where the maturity of the scheme is fixed. Let's say if it's a 5-year target maturity fund, then all the investments in the scheme will happen with the maturity of 5 years. After 6 months, the new money that comes in will be invested for a maturity of 4.5 years. So, therefore, the scheme will have a common termination date. In this case, again, the investor will have a fair idea of what is going to be the quality of the portfolio, and he will know exactly what kind of a return profile to expect. What we have so far in India are the products which have been largely comprising of the state development loans and AAA PSU bonds. The total AUM of the passive funds on the debt side has grown to about 53,000 crores from about 30,000 crores last year. So we have seen about a 70% plus growth in the passive debt funds. A large majority of that money has come into the target maturity funds, because if you will recall, there was a time when the fixed maturity plans were very popular, and now the target maturity fund gives a similar profile and character, and therefore the investors are able to guess with a reasonable amount of certainty as to what kind of portfolio to expect and what kind of return to expect. So therefore the debt ETFs with a target maturity profile are becoming very popular at this point in time.
Harish, is this certainty of knowing what you're going to get at the end of the day? Is that what's driving this interest towards target maturity funds? And what are some of the other advantages it would have over an FMP?
So, to my mind, there are three factors that actually are very useful if you're considering these passive debt funds. The first factor is, as Mr. Jaju said, the fact that the securities which they are going to buy into, they would not be churned by the fund manager. So the idea is to just stick to the original maturity till the last day and not have any churning at all. What it does is, even if there is any interest rate fluctuations, or more specifically, if interest rate goes up, which most of us are expecting in times to come, in years to come, you will not really have an interest rate risk in your portfolio if you hold on to the actual maturity of the fund. So you can just invest, for example, in a 5-year passive ETF or an index fund, stay on for 5 years and not have any interest rate risk in your portfolio. As Mr. Jaju also said, that most of the indices that is available now with us, there are about 14 fixed income indices available from NSE. Most of them have a mix of AAA rated corporate bonds, state government bonds, and central government bonds. So automatically what is happening is that the credit risk element is also negligible. So it's a very useful product for any investor to have in their core portfolio of fixed income. The second important advantage that these passive funds are bringing in is the cost advantage. So if you look at the expense ratio of most of these ETFs which are available in the market now, the expense ratio is typically in about 10 to 15 basis points range. Whereas in the active funds, if you look at the debt funds category of medium term or long term, you would probably see the expense ratio at maybe 75 basis points or even a percent. So you're getting a straight 50 to 60 basis point cost reduction by investing in a ETF, which is the same case you see for example, an equity ETF. Now, in an environment where you're earning 5 to 6% from fixed income, even a 50, 60 basis points reduction in cost is very, very significant savings for the investors. So that cost advantage is very, very good. And as Mr. Jaju said, FMPs used to be available for this, but this product is actually turning out to be much better, which explains the increase in AUM and interest as well.
But in this environment, Harish, where rates may rise, uh, wouldn't an investor be better off in, say, a floating rate bond fund, or is it just that because you want to, you have the cost advantage of a passive debt fund, you would choose a target maturity fund?
So I would think that the positioning of a floating rate fund and a target maturity fund should be a little different. So if you are an investor who wants to benefit from rising interest rates, you would want to then invest in a floating rate bond. One of the problems in Indian market is that we don't have too many floating rate securities in the truest of sense, to be honest, which really adjust the rates the way it should be. So even in a large floating rate fund, if you see, it would not be completely a floating rate instrument kind of profile. On the other hand, if you look at target maturity funds, one of the advantages and why we also advise our clients to keep it in the core portfolio is you can actually align these portfolios to your goals. So let's assume I'm an investor and we have a 4-year goal that I want to achieve. I would want a product which will give me certain returns in 4 years without any risk whatsoever. If I invest in a floating rate bond, I would still not be sure what the YTM would be because the coupons would keep adjusting. So while it may look good at this current juncture, you don't know what the interest rate is going to be 3 years down the line. If one more pandemic hits us, if rates are going down, again, there will be interest rate risk in that context for the floating rate fund. So constant maturity funds give you that certainty and you can align your goals to it. That is where you can kind of have it in your core portfolio is what we are suggesting.
Later. But first up, Mr. Jaju, let me ask you about, what are the advantages as you see it of debt passive products, and what are the different types which are available or could be innovated?
Advantage we broadly discussed. One is that the composition of the portfolio and the return expectations are pretty much clear to the investor, because one of the challenge that we have historically faced for debt markets is that investors have typically, at least that is the feedback we have, is the complication associated around the debt products, and this product simplifies a lot of things for the investors. The investors are mostly aligned with the fixed deposits of the banks or instruments which have a fixed return profile, and this product comes very close to that, and it gives them the freedom to choose the timing of their investment and the timing of redemption in case there is an emergency or exigency. These are low cost products because these are passively managed. So again, because the investors come with a certain time horizon in mind, in most cases the turnover or the portfolio uh, turnover is very low, and therefore the transaction costs are again very minimal. So the investor benefits from having a better alignment with his objectives or the investment purpose, knowing with a reasonable certainty what to expect, and low transaction and the uh, expense ratio. And therefore,
Right.
as I said, like the vast majority of the outstanding AUM in these products is in the target maturity funds. Out of a total outstanding of the ETFs and index funds on the debt side of about 53,000 crore, almost everything, which is roughly 52,000 crores, is in target maturity fund. So this is the single largest popular variety at this point.
Harish, you had said also that you're recommending that investors keep these funds as part of their core portfolio. So, what are the other funds that would work well in conjunction with target maturity fund?
So, three things which we typically recommend to any of our investors in their core fixed income portfolio. The first one is a good corporate income or a corporate bond fund. So, you can pick a 5 to 7 years medium term duration where the yields are actually very attractive. You can see corporate bond yields at even 75, 100 basis points above their corresponding G-Secs. So, you can target a good credit quality fund where it has exposure to AAA and maybe a little bit of AA, and you can keep that in your core portfolio for your medium term to long term fixed income allocation. The second fund, which can definitely be a part of your core portfolio, is a floating rate fund, as you rightly said, especially for the next couple of years, because we are pretty much at the cusp of a new cycle where RBI could increase rates. So you want to benefit from that. So a floating rate fund would help you in that category. The third is for your goal seeking objectives. If you want to purely align your specific short term, medium term goals, we can actually keep these target maturity passive funds. Because if you look at the spectrum of these funds available, we have anywhere between 2 to almost 11 years of maturity available now. So we can pretty much pick any of those funds.
Okay. Mr. Jaju, just like we tell investors not to time the market, we also say not to time the interest rate cycle, right? Nevertheless, around this time is when we get a lot of queries saying that, I hear the RBI is about to raise rates. What should I do with my debt portfolio? In a scenario like this, how would you suggest both new and existing debt fund investors approach target maturity funds? Is it a time for new investments? Is it a time to review investments? What should they do?
So I think it's an ongoing exercise, and as everyone expects that possibly the interest rates have bottomed out in the current cycle, and therefore one largely would expect some hike or increase in the interest rates over the next 1 year. Whether that is the reason for a wholesale churn in the portfolio, possibly not, because each investor has different goals, and each investor has a different risk profile. So I would say that Harish is the best person to advise, and in a specific case as to what should be the attempt. But at a general level, I think money which is invested with a long term horizon. So let's say investor has more than 3 years investment horizon, has some risk taking ability. Experience has shown that every time one complete interest rate cycle is completed, the investors get very good return. So if you start at point X and let the interest rate cycle complete, let's take example of 2018. 10 years started from 6%, went up to 9%, and then came back to 6%. Investors made close to double digit returns. Where do the ETFs and the index fund fit into this whole discussion about allocation to different types of debt funds and in relation to the ongoing interest rate cycle? There are a huge set of investors who prefer certainty and risk management over the lure of the higher return. And for those kind of people, this is a product which gives you a risk and return profile which is closest to what they are very comfortable with, which is the debt ETFs is the tax advantage, because if they hold it for the minimum threshold period, the investor will be eligible for long-term capital gain taxation, and that makes a huge difference in an environment where the absolute level of interest rates are low at around say 5 or 6%. So I would say that for investors who have a clearly identified return expectation and who do not want volatility, this is a very good fit. And with the additional benefit of the LTCG gains.
Since we're talking about taxation, Harish, one of the advantages of this FMP was also that you bought it in season, which is March, you would get that benefit of extra indexation, right? Uh, does missing that benefit of extra indexation, will that miss be made up for adequately if you were to invest in a target maturity fund?
So you're right, Sumera. I mean, FMPs were timed by the industry to come around that March phase so that you can actually get the benefit of 4 financial years indexation in CII. However, the same thing can be done by investors in target maturity passive funds also because they're open-ended. So one of the disadvantages of an FMP for any investor was if they miss that, if I may call the word season, they will not be able to enter an FMP otherwise because even though they were listed, the secondary market liquidity was never good. In these funds, which are actually open-ended, you can always enter and exit at any point in time you want. Especially in the index funds, there would anyways not be a liquidity problem at all. So you can create your own season, if I may call it that way, where you can pick a 3.5 year time frame. Actually, over a period of 4 years, you can get the indexation benefit here also. So there is no real disadvantage as compared to FMPs with better liquidity. So I think this fund category would win over that also.
Okay. Mr. Jaju, if somebody was to look at a target maturity fund, and what happens on the passive side is that there's not a lot of differentiators between schemes from different fund houses, right? So if an investor was to look, what were the 3 or 4 things they would look for to help them make the right selection?
Well, I think, as you rightly said, that on the debt side, the challenge for the investor has always been to pick up the right option and then the right scheme within the option. And therefore, target maturity ETFs and the other ETFs provide an easy identification in terms of the option that they want to choose. That is what type of fund. Now, when the investor looks at which particular scheme to pick up, there are three main identifiers or differentiators. One is the composition of the index, because the index has to have a mix in a way that it should have a diversified portfolio, so that any illiquidity or any other issue in one particular segment should not have impact on the entire portfolio. The second is that the tracking error that the fund will generate. So one can look at the track record of the same fund house or the same fund manager or the category of those schemes. So one can identify what parameters they want to evaluate. But the schemes with the minimum tracking error, which means the deviation between the return of the index and the fund, that should be the one which should be prioritized, because therefore in that case the alignment of the investor's expectation will be best fit with the scheme. And finally, the expense ratio, that is an important factor, because it's very simple. The lower the expense, the better the return to the investor. So in that order, the portfolio quality and diversification, tracking error, and the expense ratio, these are some of the parameters that the investors can monitor.
Okay. Harish, would one target maturity fund in somebody's core portfolio suffice? Would they need more than one? And how do, the same question to you, which I asked Mr. Jaju, how do they select the right fund for them?
So I won't add the same point that Mr. Jaju said about the expense ratio as far as the composition of the fund. I think if I were an investor, I would look at two aspects of target maturity funds that are available. The first aspect is linking those funds to my goals. So I'm a financial advisor, and we basically go and talk to the investors and say markets are not there to try and become the best investor ever or time the market, as you said. We want to benefit from it for our own financial purposes and goals. So if you have a financial goal now, as I said earlier, up to even 10, 11 years, and you don't want the volatility of the equity market, you have a product here at low cost which can actually be aligned to your goals. That is one way of picking which fund you want. So if you have goals for 3 years and one for 7 years and one for 10 years, you might want actually three different target maturity funds for these 3 years. If an investor is looking to try and diversify their existing portfolio and not necessarily aligning it to a goal, then what they can look at is the composition of the fund from a credit quality point of view. So while everything is AAA and SDL and government bonds, there is a lot of advantage sometimes AAA can offer you in terms of yield benefits. So you might want to add a little bit of an yield enhancement into your portfolio by going into a AAA rated target maturity fund over, let's say, a pure play government security fund. So this is how the investor will have to approach this category and say which one looks good for my portfolio.
Mr. Jaju, Harish, thank you very much for explaining this topic in a language that we can understand. The passive side of debt funds, and especially target maturity funds, is a topic that we've learned a lot from during this webinar. So thank you very much for that. And for everybody who's watching, I hope that this has been a learning experience for you as well. So thank you very much for tuning in. Stay safe.
Mutual fund investments are subject to market risks. Read all the scheme-related documents carefully.